Hello and welcome to Pensions in 10 with me, David Brooks, and my colleague, Sadhbh Lynch. This week we take a look at, of course, a market update regarding the Trump tariffs. We take a look all the way around the world to the Australian supers who've been under a cyber attack, and Sadhbh takes us through TPR's latest on climate change and small schemes. Okay, Sadhbh, so here I am again, and here you are again, but this time it's your turn to tell us about Trump. We've had Andy telling us last week about the Trump tariffs. We had a podcast I did with Matthew Downey last week as well, which dated very quickly. So given all the ups and downs, can you give us a very brief rundown of what you've been seeing in the last week and as of this morning around the Trump tariffs?
Yeah, of course. So both of those podcasts probably aged quite badly. So on the 9th of April, there was a bit of a reversal in the tariff. So initially, it was a bit of a complicated structure. Now I'm sure everyone's seen 10% tariffs across all countries, so 185 countries, except for China. So all of the volatility for the last few weeks has caused a lot of uncertainty in the markets, which can be good and bad for trustees depending on where they're positioned. So I'll go through three major asset classes, which we usually consider. I think Matthew Downey did something similar. So equities is the first one, mainly for DC schemes, but obviously DB schemes too. The FTSE 100, so the biggest 100 companies in the UK, is down 7%. So this was 9% before that pause, so it's a bit of a recovery. S&P 500, which is the US version, so 500 biggest companies in the US, that's down only 3% in the last month now. So that was 11%, so quite a big recovery there. So we have seen some up and downs in the equity market, but it's recovered across the board since that pause, which is beneficial for sure. And when we look at it from a long-term perspective, these really are like minor volatilities, so nothing in comparison to those bigger crises we've seen before, which is good. And also equities over the past few years have gone up a lot. So even though these are some negative returns, trustees shouldn't be too worried because overall they're still above where they were this time last year. So I know it seems kind of negative, but overall, if you zoom out, it's not too bad. Government bonds, so gilt yields, we've seen to be very volatile over the past month. So they went down initially, now they're going slightly back up. So there has been a slight rise in those gilt yields, still below where they were in January. So again, not too much volatility when you zoom out a few months, but they definitely did have a dip and go back up again. And then the last one is corporate bonds. So both DC schemes and DB schemes will usually be invested in corporate bonds. And there's this thing called a credit spread, which I know some people don't like. But that's basically the reward or the risk that you take for investing in a company rather than a government. So usually you'll get a bit of extra return for investing or lending money to a company because it's inherently a bit more risky and they are more likely to not repay that money. So that credit spread is basically the reward you get for taking that risk. Those spreads have widened because everyone's uncertain in the market, they're not sure who it's going to affect. But when you zoom out and look at historical spreads, they're actually still kind of tighter than what we've seen historically. So again, a bit of volatility there, but not too much to worry about. It's not actually too much when you look out to the wider.
Okay, that's really helpful. I think zoom out is going to be my new favorite phrase. I think I mentioned it on a previous one of these Pensions in 10 when following the budget, and I was getting very excited about gilt yield movements, and our chief actuary David Hamilton told me to zoom out.
Yeah.
Because you can get kind of zoned in a bit on the charts where the charts represent themselves. Sometimes you can see like massive ups and downs, but then you zoom out. And actually related to that, I was looking this morning, thinking about what we're going to talk about today. I sort of zoomed out at gilt yields as well, and sort of when you can see that. Okay, I was thinking about a scheme, say a pension scheme had a valuation over this period with a lot of volatility, say 6th of April, slightly before it, but any kind of movement around this time. But then gilt yields in 2022 wouldn't have been their last. Is that right? Yeah, 2022 would have been their last valuation. Gilt yields were 2%, around 2, and now they're up at near 5. So I don't know if you've thought about how those schemes that have a valuation around this time, whether they should be worried. That's probably the only thing. If you're going to have a natural evaluation in the middle of all this noise, that's when it might have some material impacts.
Yeah, so I think it will definitely, unfortunately, have an impact for those who are scheme year end is 5th of April. So 31st of March should avoid this. 5th of April might be slightly affected. So we saw, if you look at the last few weeks, a dip in the gilt yields around that 5th of April time. So just before that pause in tariffs was announced, which could have an impact, as when gilt yields are lower, the present value of liabilities for DB schemes are higher, which is unfortunate, especially if they're not hedged. So if you're not 100% hedged, this could have an impact. And then also, there's kind of two different branches to it. The growth assets, so like your equities or property or anything, so the returns generating assets, those were majorly dipped at that point. So at that 5th of April point, that's before the pause. So it's kind of two different things leading to kind of a worse funding level position. So it is slightly an issue for people who have that 5th of April valuation date, which is slightly unfortunate.
Yeah, no, potentially. I suppose, but again, if we zoom out,
yeah, exactly.
Things are different from 3 years on, but I think it would be remiss not to mention it. Just in the last sort of, I won't say a time, 30 seconds maybe. Can you give us a very quick summary of, what DB scheme trustees and perhaps DC trustees should just be thinking about during these periods?
Yes, for sure. So both of them, I would say, don't rush into action. It's always bad to make decisions when markets are this volatile. An interesting point that we've all considered within my team is that so foreign exchange, so that's like currency movements between different currencies, are moving in a way that they haven't been historically. So usually the dollar was getting stronger, we're now seeing the dollar weakening. So it's definitely a time to review and just make sure that if you have any unhedged positions, so say you're invested in a world equity fund, just make sure that you know which ones of these funds aren't hedged back to sterling, and it might be a good time to hedge them back to sterling if you are worried about any like movements within foreign currency markets. But I would say overall, don't try not to panic. Make sure you're hedging and your collateral waterfalls in place in case there are any more movements in yields. There haven't been too much movements yet, but just make sure that your governance is all kind of put in place. But it should all be fine. So yeah, just stay calm and don't make any rash decisions, really.
There you go. Very calming words. Thank you, Sadhbh.
Okay, Dave, so do you want to tell us about the cybersecurity hacks that we've seen on Australia Super?
Yes. So it always focuses the mind when you hear of stories of a cyber attack somewhere, because it just gets people concerned. So there was some suspicious activity in Australia across the Australian Retirement Trust, Host Plus, and the Rest Super. I won't go into details of what kind of people are in those schemes, but they're big, multi-billion-dollar pension schemes, and they reported that there were unauthorized transfers of monies and unauthorized access to people's pension funds within those schemes, which is a sort of an attack we haven't seen much of in the past. We've seen sort of attacks on providers at a higher level, trying to get access to data, ransoms and these kind of things, but not seeing actual attacks on individuals, and so actually trying to impersonate them and sort of transact movements of money and things from their pension into another arrangement. And so it does focus the mind for any trustees listening around cyber controls, ensuring that DC member assets are safe. For me personally, when I've talked about cyber with clients and thought about it, I think it is an area of concern. And I also think, sort of around the money holders. So, okay, there's a lot of worry about them individual data, being compromised and stolen and then being used, this kind of stuff. And that is serious. But one of my big worries is, could a hacker impersonate a board of trustees and authorize a transaction from a fund manager where there's multi-millions, billions of pounds sitting there? That for me is a bigger risk than perhaps has been discussed in the industry to date. So kind of brings to mind the fact that these hackers are working out different ways of attacking pension schemes. This is happening in Australia. It could easily happen in the UK and beyond. Aligned to this, I just want to know as well that PSAG have been working on a tool with the regulator to highlight dodgy websites that may be targeting individuals, and they've taken down 29 high-risk sites and referred 94 others to further agencies to review, which is great news. So kind of trying to deal with scams and dodgy activity at source is just great as well. So kind of two linked stories of cybersecurity and scamming. It's a dangerous world out there, so it's good to see that things are being done on one hand to fix it, but it does feel like there's more work to do to make sure that pension benefits are safe.
Yeah, I agree.
Okay, so our final story, we're going to quickly look at the pensions regulator who's been talking about small schemes, small DC schemes again, and this time focusing on what they should be doing to protect members and savers against the risk of climate change. Tell us all about that.
Yeah, so the regulator found that these smaller DC schemes weren't really focusing on climate risk, and they actually came out with some pretty strong wording to do with it. So they said that DC schemes who are not taking appropriate action should consider exiting the market. So some very strong words here from the regulator around climate change risk, and the issues that trustees might face if they don't want to do more. And they found this issue mainly within smaller schemes. Larger schemes, they didn't really find any issues with there. So yeah, something to definitely look out for.
Yeah, so what should trustees really be doing around this?
Yeah, so there's a lot of different avenues that you can take to consider climate change risk. So firstly, if you're making any investment decisions, trustees should consider all of the financial risks from climate change. So there's three main risks we usually think about. Firstly is transition risk. So that's the risk of transitioning to a low carbon economy. Second is physical risk. So that's the risk of increasing weather events, so like flooding, fires, tornadoes, etc. And the last one, kind of the hardest I usually think to think about, is market risk or pricing in risk. So that's the risk that your assets will fall in value when the market truly prices in climate change risk. So definitely considering all those three risks when making investment decisions. TPR have said that they are encouraging schemes to go beyond minimum compliance to manage and monitor also these risks. And they say that they will actually enforce action against trustees who are failing to meet their statutory duties on climate change. So trustees should definitely be educating themselves, upskilling themselves on these risks. That's very vital. This will allow them to distinguish between any firms that are acting responsibly and those that are at risk of becoming stranded assets, which can have a massive impact on your portfolio. So it's really important for DC schemes especially. I think that's why they're focused here, as DC tends to be much more longer term, and these climate risks we really see ramping up in the next 10, 20, 30 years. It's definitely something to the trustees to keep aware of. Yeah.
Yeah, and it does feel like climate change has been one of those sort of odd metrics for investments. It's been around now for a good few years. Sustainability and impact investing, all these kind of things aren't new, but this focus on climate change, it came through from the general code, which was definitely an upgrade from being a non-financial factor to a material financial factor, which trustees should be considering. It just feels like there's a lag in some areas, and that's probably what the TPR is noticing, that there's a lag that's not sort of drifting down to the smaller schemes to take the time to do something about this, whether there's some skepticism around climate change and what can actually be done, or even, I suppose, small schemes might just feel like we're just powerless to do anything. But I think this is really, as you said, the language the regulator has used is really quite strong. I know, again, the governance side of things, small schemes, they also talked about something else this week around small schemes. There is a drive for consolidation, and this is going to be one of the sticks the regulator's going to use. If schemes aren't picking up this as being a material factor to actually do, then the regulator is going to come along and make you move out of the market and transfer to a larger scheme that does. So I think it is quite an important area, and trustees should be taking notice.
Yeah, definitely something to be aware of. So thank you for listening. Make sure to subscribe if you want to get these through your inbox each week, and we'll see you next week.